Hey everybody, thanks for joining me this evening. I'm Brannon Moncrief with McLaren and Associates, and tonight I'll be talking about unpacking DSO affiliations. So we're going to spend about the next hour and 15 minutes talking everything DSOs. I'm going to cover a lot of ground, a little bit of housekeeping before we get started. If you have a question, on the right side of your screen, there should be a Q&A panel, and you can type in whatever question you'd like to ask and hit send. I'd love for this presentation to be as interactive as possible. I want to make sure that you get everything that you want to get out of our webinar tonight. So with that, I will hop in talking about unpacking DSO affiliations. So before we get started and get into the meat of the presentation, just a little bit about McLaren Associates and myself. Again, my name's Brannon Moncrief. I'm the principal CEO of McLaren and Associates, and I've got about 23 years of dental industry experience. I spent the first decade of my career lending money to dentists all across the country to buy, start, and expand practices. So I worked with every practice broker, dental CPA, dental attorney you could imagine in that role, and funded several hundred dental practice acquisitions and startups during my 10-year career as a banker. I purchased McLaren and Associates about 13 years ago. And at the time that I bought the company, it was kind of a mom and pop practice brokerage company like those that you see out there today. And myself, along with the help of our team, have expanded that business to do about 50 to 60 doctor to doctor practice sales a year and another 30 to 40 DSO and private equity transactions every year. So 23 years of dental industry experience, really focused on banking and M&A. I've really seen everything that can go right and wrong in a practice sale, a practice transition, a DSO affiliation. I couldn't do what I do every day without our fantastic team. So we got a very diverse team, a lot of young, bright people. My brother and business partner, Ryan Moncrief, is a former Patterson rep. We've got a CPA on the team, several financial analysts. A lot of us have a banking background. We've got a former investment banker on the team who has an MBA from Wharton and a law degree from UPenn. So fantastic team of 13 people that serve our clients nationwide. I'm broadcasting tonight from Austin, Texas. That's where we're headquartered. We also have an office in San Diego on the West Coast and an office in Atlanta on the East Coast. So truly nationwide. At any given time, we've got about 20 to 30 practices on the market looking to sell in a traditional sense to another doctor, and 20 to 30 larger practices that are looking to affiliate with a DSO or partner with private equity. We've closed over 1,500 practice sales in our 35-year history as a company, representing about 1.5 billion in closed transaction volume. That just to say that, again, we've seen every iteration of practice sale you could possibly imagine. We've seen everything that can go right and go wrong. Really well-versed team with over 100 years of collective dental industry experience. All right, so let's hop into the meat of it. Before we get started, I want to talk about some terminology. Obviously, with private equity's entry into our space, EBITDA has become a hot topic. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Think of EBITDA as absentee owner profit, right? So you've got revenue minus overhead. And we're talking about real overhead expenses after accounting for any non-recurring expenses, non-cash expenses like depreciation, amortization, and accounting for any personal benefits that you're writing off through your business. We know the name of the game is to pay as little taxes as possible. So most business owners are pretty aggressive in writing off personal and discretionary expenses through their business. Our job is to do a deep dive on your financials and determine what is your true operating cost, what is your true overhead, and what is your EBITDA. So revenue minus true overhead minus doctor compensation. What would you have to pay yourself or other doctors to produce that same level of dentistry? Whatever's left over at the end of the day, after accounting for real overhead expenses and doctor compensation, is EBITDA. And oftentimes, the big mistake that people make when calculating EBITDA, is failing to calculate in a market wage for the doctors to do the dentistry. I get calls all the time. Hey, Brandon, I've got a practice with top line revenue of 1.2 million. My EBITDA is 400,000. Time out. Did you pay yourself to do the dentistry? And most of the time, the answer to that question is no. EBITDA is not 400,000. It's actually 150 or 200,000 after paying yourself a market wage to work chairside. So think of EBITDA as absentee owner profit. Valuations from a private equity DSO perspective are a function of a multiple of EBITDA, and we'll get into that here in a minute. What is private equity? This is the institutional investor that is fueling the consolidation of our industry by DSOs. So, private equity or a family office, that's a group of typically MBAs, business professionals that pool capital from investors and invest that capital across many different industries in what they call a buy and build strategy. So they're going to buy established businesses, they're going to build infrastructure around them, leverage economies of scale, and then sell that business for a higher multiple, higher EBITDA multiple than they paid to acquire that business. And through leveraging economies of scale and centralizing business functions, hopefully they're going to drive down overhead, drive up EBITDA, drive up profit, and then sell the business in typically a 5-year window, what we call a recapitalization cycle, at a recap event. At a recap event, that's where the financial sponsor, the private equity firm or the family office that backs that DSO, sells the DSO to the next investor. And at that recap event, not only the financial sponsor, but also the management team of the DSO and the doctors that hold equity in that DSO have the opportunity to exit that equity in part or in full, hopefully at a handsome return. And over the past 5 years, 7 years, a lot of the investors in these DSOs have realized a 3 to 7 times return on invested capital. So really robust returns in the dental industry, over the past 5 to 7 years. Arbitrage refers to that gain, the difference between invested capital and the return that you generate at recap. Equity versus leverage. Equity refers to equity refers to cash invested in the company. Leverage refers to debt, borrowed funds. And any investment that's typically backed by private equity or family office is heavily leveraged. You generate arbitrage, you generate return by two ways. By buying the asset for, let's say, 7 or 8 times EBITDA, and then selling it at recap for 10 to 12 times EBITDA, right? Buying low and selling high. That's one way to generate return. But through the use of leverage, through the use of debt, that's going to juice the return exponentially. So I think it's important to understand, how does private equity make money in our industry? And I'll break it down for you really quick. So a lot of people look at, okay, DSOs are buying practices for 7 times EBITDA, and then they're packaging them together, they're integrating them, they're combining the cap table, they're leveraging economies of scale, they're centralizing business functions, and then they're selling that business at recap for, let's say, 14 times EBITDA, right? So you buy for 7 times EBITDA, you sell for 14 times EBITDA. Well, most people think, okay, well, they doubled their money. The reality is, though, in many cases, they tripled or quadrupled their money through the use of applying leverage through the business. So we'll look at that through the lens of the example of buying a home that appreciates and using debt to fund the purchase of that home. So let's say, for instance, that you purchased a house for $400,000, and 5 years later, you sold that house for $800,000. Quick math, you doubled your money. However, we both know that in high likelihood, you borrowed money to buy that house initially. So rather than investing $400,000 cash to purchase that home, you invested $100,000 cash and borrowed $300,000 from the bank. Well, 5 years later, when you sell that home for $800,000, let's say you haven't reduced the principal on the mortgage at all, so you still owe $300,000. So you take that $800,000, you pay back the bank $300,000, you've got $500,000 left. You initially invested $100,000. So you generated a 4x return on your money through the use of leverage. So you generated an exponentially higher arbitrage, exponentially higher gain through not only buying the asset for 400,000 and selling for 800,000, but also applying leverage to the purchase, which exponentially reduced your return on sale. It works the same exact way with private equity backed companies and DSOs. Last thing to unpack when we talk about DSO deal structures, and we're going to get into that in a minute. When we talk about joint venture equity, JV equity, that refers to practice level equity, retained equity in your own business, versus talking about holding company equity or holding company stock. That's referring to stock in the parent company of the DSO. So let's talk about DSO version 1.0. And you can see the graphic that I have here. I think this is really the version of DSOs that gave DSOs a bad name, that turned DSOs kind of into a four-letter word in our industry for a long time. Most of these DSOs utilize a de novo model, meaning that they specialized in starting practices from scratch. All of the practices under the umbrella shared the same brand, the same culture. These were really kind of clinic style models, doc in the box, if you will. They really weren't focused on looking at the providers, the clinicians as partners. They just looked at them as employees. They didn't allow the doctors to invest alongside them and actually own equity at the practice level or at the holding company level. So, in large part, there wasn't proper alignment of incentives with the providers, and there wasn't really a focus on clinical care and clinical autonomy. And therefore, this version of DSO really gave DSO a bad rap, and most of these DSOs crashed and burned. So, DSO version 1.0, I would say, was more so driven by the suits, more so driven by the MBAs, and not really driven by the doctors. But this new iteration of DSOs has become a legitimate transition option. So, you see the graphic here. It's more of a partnership model where DSOs are utilizing that buy and build strategy. They're buying fantastic practices, they're partnering with great doctors, and they're staying out of their way clinically. So they're allowing the doctors to have pure clinical autonomy, and they're supporting them behind the veil from an operational, from a business perspective. So that's what most of our clients are looking for, is help in managing the business and fighting, pushing against some of the headwinds that dentistry is facing when we talk about rising overhead costs, when we talk about a labor crisis. As we all know, since COVID, we've been kind of living day to day in an HR nightmare. And we've got downward pressure on pricing from TPO infiltration. So DSOs are designed to help fight some of those headwinds. They centralize a lot of the business functions in getting that off the doctor's plate, getting it in the hands of people that are good at it and are assigned one particular job from an administrative perspective on a daily basis. And then they leverage economies of scale. Because of their size, they're able to negotiate better reimbursement rates with payers. Because of their size, they're able to negotiate better pricing with vendors. They can buy equipment and supplies for 30 to 40% less than you can. They can negotiate with PPOs for 20% better reimbursement rates than you can. They are better positioned to fight some of the headwinds that you're facing as a private practice owner. So the big change is that they look to acquire practices rather than start practices from scratch. They actually partner with clinicians and allow dentists to participate in the financial arbitrage that the financial sponsor is generating through those recap events and the eventual sale of the company. They allow for pure clinical autonomy and a lot of operational autonomy. So that is a marked change comparison compared to DSO version 1.0. And that's the reason why so many providers, so many practice owners have chosen to affiliate with DSOs over the past 5 years comparative to the previous 20 years. Okay, so now let's talk a little bit about market conditions because they have changed pretty substantially over the past decade. So pre-COVID, Private equity was operating with ideal macroeconomic conditions. So historically low interest rates, along with very loose capital markets. Money was cheap and it was easy to get access to. So ideal macroeconomic conditions for private equity to operate in. Approximately 250 DSOs were operating nationwide. Dentistry was arguably the hottest vertical that private equity was investing in. So for a long time, it was veterinary medicine, and then it became dentistry. So private equity loved dentistry pre-COVID. Most individual practices were trading for 5 to 7 times EBITDA. And then platform investments, we're talking about multi-site practices with EBITDA of 2 million plus, were trading for north of 10 times EBITDA in a lot of cases. Most DSOs were utilizing a traditional private equity deal structure. What does that mean? So, a holding company deal structure, and we're going to unpack deal structures here in a little bit, whereby you're going to monetize, let's say, 70% of your business at close, 70% cash at close, and the remaining part of the deal was stock in the holding company of the DSO. So that's a holding company structure where you actually don't retain equity at the practice level. Any equity, any stock that you own is at the DSO corporate level. That was the common deal structure that was being utilized pre-COVID. Now, there were other elements of deal structures that were present pre-COVID because the market was not as competitive. There weren't as many DSOs bidding on practices as there were post-COVID and today. As a result, there were a lot of holdbacks, earnouts, things of that nature. So most deal structures involved a cash at close component, let's say somewhere in the range of 60 to 70% cash at close, some type of earnout or holdback that could be 10 to 20% of the deal, whereby you've got to work a certain number of years and produce at a certain clip, and the practice has to realize a certain level of revenue for you to earn that money. And then the remainder was typically stock in the holding company of the DSO. The post-closing commitment was only 2 to 3 years in most cases, but that came with pretty strict guardrails. You had to stay on chair side at least 2 to 3 years. You had to continue working a certain number of days a week or a month or a year, and you had to continue to produce at a certain clip in order to get that holdback and for your equity not to be clawed back or diluted. So we'll talk about in a minute how that's changed pretty significantly over the past 3 years. I want to remind you as we go through the webinar tonight, if you have a question, please type it in the bottom right-hand corner and hit send. I would love to do as much Q&A along the way as possible. All right, let's talk about post-COVID market conditions. What did things look like coming out of COVID? So private equity still operating with ideal macroeconomic conditions post-COVID. Low interest rates, capital markets were wide open, cheap money, and easy to acquire. Dentistry rebounded extremely quickly. Dentistry rebounded arguably faster than any other healthcare vertical. Dentistry was way ahead of other industries, other healthcare industries as far as airborne illness is concerned. So I think dentistry did a great job of controlling the narrative during COVID and post-COVID. Patients felt comfortable coming back to their dentist in the year following the COVID shutdown, and dentistry rebounded remarkably quickly. For a lot of practices, 21, 22 were their best years ever. So private equity already loved dentistry going into COVID. Dentistry had proven time and time again to be somewhat recession proof. Then it proved to be pandemic proof. And when that happened, there were already a lot of private equity firms that had a DSO. They were already invested in dentistry. They began buying practices at an even faster clip. Those private equity firms that were eyeing an investment in dentistry leading up to COVID, they invested. They bought a platform and started building a DSO. So the number of DSOs, it literally feels like it doubled overnight coming out of COVID. And simple economics, right? Steady supply of sellers, increased demand led to an insane seller's market in 2021 and 2022. 2022 was the top year for acquisition activity in the private equity world, period, in the history of private equity. And dentistry saw more interest from private equity in their busiest year ever than any other industry out there. So many recaps occurred at EBITDA multiples of 13 to 16 times EBITDA in the couple of years coming out of COVID. Most individual practices traded for 7 to 9 times EBITDA. So valuations increased by about 30% overnight compared to where they were at pre-COVID. Platform investments, those multi-site practices with EBITDA of 2 million plus, were trading for 10 to 13 times EBITDA. One of the marked changes that we saw coming out of COVID was that private equity realized that uh, doctor turnover, in particular founder turnover, was their Achilles heel. So joint venture and hybrid deal structures became a lot more popular than the pure holding company structure. Well, what does that mean? That joint venture equity is retained equity at the practice level. So because founder turnover led to softening numbers in a lot of practices, right? Once the seller eventually exited the business, revenue went down, EBITDA went down. DSOs, private equity, got wise, and they realized that they need pure alignment of incentives. So they started requiring doctors, or you could say allowing doctors, to retain equity at the practice level. A true partnership model evolved, whereby the DSO would own 60 to 70% of the practice, and the doctor would own anywhere from 20 to 40% of the practice. So alignment of incentives at the local level became a hot button for DSOs. And again, we're going to get into DSO deal structures in more detail here in just a little bit, because there was so much buying activity. There's so much competition among DSOs. A lot of the holdbacks, a lot of the earnouts that you saw pre-COVID, they disappeared. Deal structures got really, really clean. They were a combination of cash at close, somewhere in the range of 60 to 75%, and equity, whether that equity was at the practice level, the DSO holding company level, or both. That said, while deal structures got a lot cleaner, again, DSOs, private equity got smart. They realized that doctor turnover is their Achilles heel. So the post-closing commitment increased from 2 to 3 years to 5 years. So DSOs want the seller involved in the business for a prolonged period of time. However, whereas pre-COVID, that post-closing requirement had a lot of guardrails. You had to work a certain number of days a week, a month. You had to produce at a certain level. This new guideline of a 5-year post-closing commitment comes with a lot of autonomy. So you don't have to work chairside at all. DSOs don't really care who's producing the dentistry. They just care that the pre-sale revenue and EBITDA is maintained for at least 5 years post-sale. So they just want the seller to have a vested interest in the continued success of the business. But you can work as much or as little as you want to chairside. Now, because it was a frothy market and dentistry was arguably the hottest vertical that private equity was investing in, there was so much competition among buyers. There was a little bit of a lack of discipline. Buyers were buying everything. 3, 4 years ago, we could sell almost anything to a DSO, and they weren't really integrating and operating the practices that they were acquiring. So as a result, it led to, a little bit of heartburn over the past couple of years, in combination with a marked change in the macroeconomic environment. All right. So I think this graphic represents what's happened over the past 18 months really well. And I picked this graphic because I grew up in Houston, Texas. And anybody that's lived along the Gulf Coast knows exactly what this graphic means. This is a hurricane. Essentially, this is what happened in our industry, as well as any industry that had significant private equity involvement. There was a massive shift in macroeconomic conditions, essentially overnight. What I mean by that, interest rates increased faster over the past 18 months than they had in the history of the Fed. And again, these are highly leveraged investments. DSOs carry a lot of debt. And when you double or triple interest rates, when you go from borrowing money at 6, 7%, and all of a sudden, you're on a floating rate instrument and your interest rate goes up to 12, 13, 14%, that considerably eats into your margin. And the capital markets also tightened considerably. So whereas DSOs thought that they were going to recap at 15x over the past 18 months, the bidders that have been out there have been looking to buy at more in the 10 to 12x range. Well, DSOs were acquiring practices in that frothy environment at 8x, 9x, 10x, expecting that they'd be able to sell for 15 or 16x when the market pulled back, when money got significantly more expensive and harder to get access to. It changed the game on the back end at recap. And therefore, it changed the game to some degree on the front end. So, as a result of the unexpected and rapid change in macroeconomic conditions, some DSOs have been on the sidelines, right? They've either been over levered or they've been over their skis operationally. They weren't actually integrating and operating the assets that they were acquiring in the couple of years following COVID. So they've been on the sidelines. They haven't been able to buy practices. A lot of the bigger DSOs that were really well known for paying elevated multiples and buying a lot of assets coming out of COVID have not been buying practices over the past 18 months. The good news is there's been plenty of emerging and smaller DSOs that have stepped up to fill that void. They took on private equity money more recently. They're not over levered. They still have plenty of money left on their lines of credit with their banks. And because they've stepped up to fill that void, we really haven't seen a marked change in valuations. Valuation peaked, I would say, in 2022 and have stayed pretty steady, but only for Class A assets, right? We're talking about practices with multiple providers, multi-million dollar revenue practices, EBITDA of 500,000 plus, clean financials, well run, where the seller is willing to give at least a 5-year commitment. Those practices still trading for 7 to 8.5 times EBITDA. We've closed multiple deals that fit that description over the past 6 months at 8 times EBITDA or higher. So the Class A assets are still trading for elevated multiples and still have plenty of bids. The smaller assets, those with the little hair on them, murky financials, maybe the seller wants a shorter post-closing commitment, maybe they have significant Medicaid exposure and they're not pedo. Assets with certain characteristics have been harder to move. So you may see, less bids or lower bids and lighter valuations than you would have seen previously. But it's been a bifurcated market. It's kind of as a hurricane does, right? So I had the pleasure of buying a beach house 3 months in Port Aransas, Texas, 3 months prior to Hurricane Harvey, a Cat 5 hurricane hitting my beach town head on. It was fascinating to see, sad, but fascinating to see what happened to Port Aransas following the hurricane. So I still remember the first time that I went down there after the hurricane, driving around all the neighborhoods. And it was crazy the difference between what happened from house to house, right? Some houses completely wiped off the foundation, didn't even exist anymore. Other houses had moderate damage. Maybe they lost the roof, had some shingles ripped off, some broken windows. And then there were a handful of houses that looked completely untouched as if nothing had happened. No different than what's happened with this massive shift in macroeconomic conditions in DSO land. Those DSOs that were built to last, that had solid foundations, have they been under, a little bit of stress over the past 18 months because of the elevated interest rates? Sure. But they're built to last. They're going to be fine. They are going to come out of this relatively unscathed. There's been some DSOs that had moderate damage, right? Maybe they bought a handful of assets that they shouldn't have, or they overpaid for them. They're having to retool their organization a little bit, but they'll be fine. And there's a handful of DSOs that have gotten completely wiped off their foundation. So I think it's important to note, look, in any industry, whether it's privately owned or private equity backed, there's going to be a handful of companies that get a unicorn result, 5, 7x return on invested capital. There's going to be a handful of companies that go to zero. And then the other results are going to be somewhere in between. They're going to be mixed. There's going to be some good outcomes. There's going to be some mediocre outcomes. I think now more than ever, though, it's important to note not all DSOs are created equal. You have got to do diligence as a seller if you're going to go to market and look to affiliate with a DSO. And that's a big part of our job as sell side advisors. We represent large practice owners that are looking to take their practice to market. The key is to create a competitive environment, only put the best of the best options at the table so that our clients have perspective on what the industry looks like, what the options look like, and avoid potentially making a mistake and selling your business or partnering with one of those companies that's destined to go to zero, right? We want to eliminate that probability. So, a large part of what we do is spend an insane amount of time doing diligence on buyers to determine who's real, who's not, who has money, who doesn't, who has infrastructure, who is set up to be sustainable and successful long term versus those that when it hits the fan, they're going to get wiped off their foundation. So that's a big part of what we do. It's not only about driving economics and ensuring that obviously you get the highest EBITDA multiple, the highest valuation, the highest EBITDA possible, but that you also choose the right DSO to affiliate with. I just had a question come in. Appreciate the question. You said large practices is who you represent. What yearly production is considered a large practice for you? And we are going to get into what DSOs are looking for in a minute. But I would say where the conversation regarding affiliating with a DSO starts to become a little bit more compelling is around 1.5 million in revenue, because most DSOs are looking for $300,000 in EBITDA or higher. So a healthy practice is operating at an EBITDA margin of 20% plus. Well, 1.5 million in revenue, 20% EBITDA margin, $300,000 in EBITDA. That's where the conversation becomes compelling, because that's where the valuation in the DSO world starts to run away from the DSO valuation in the private buyer world, the more traditional practice sale world. So most of our clients that are going to the DSO world have revenue of 1.5 million or greater, EBITDA of 300,000. We work with clients of all size. I would say our average client has 2 to 3 locations, revenue of 3 to 8 million, and EBITDA of 1 million to 2 million. That's our average client. We work with practices that have revenue as small as 1.5 million, EBITDA as small as 300,000. And we work with clients that have, as many as 20 locations and EBITDA of 5 million plus. So we really run the full gamut. Appreciate the questions. I encourage you to keep them rolling in. Again, bottom right-hand corner of your screen in the Q&A panel, you can type a question and hit send. I'll make sure that I address it. All right, so what does the future hold? Well, we're in an election cycle, right? There's always a tremendous amount of uncertainty in an election cycle, especially right now, given that I think most people would argue we don't have great options, and they are vastly different in their approach to managing taxes, interest rates, and the economy. So I think the election is going to have an impact on what the future holds for dentistry, particularly for private equity backed DSOs. I think we're almost at 100% certainty that inflation has cooled and we're going to see a rate cut in Q3 or Q4. I'm hoping we might see as many as 2 rate cuts before the end of the year. But look, they're not going to be remarkable, right? They might be quarter point rate cuts. Rates might come down by half a point between now and the end of the year. Now, that will be a positive sign, right, to private equity and to investors and to the economy in general. So, that positive sign will go a long way in easing people's fears, at least that interest rates are not going to continue to increase. I think once interest rates come down, you're going to see the capital markets open back up. You're going to see many DSOs recap in, I think, back half of this year and the front half of next year. So I think you could see as much as a third of the DSOs hit a recap event and bring on a new financial sponsor over the next 12 to 18 months. I'm hoping that those will be at attractive EBITDA multiples, anywhere in the range of 12, 13 times EBITDA. If that's where the recaps hit, I think the market's going to look pretty healthy, pretty frothy in 2025. So that's my hope. I'm pretty bullish on 2025 and beyond. I think the consolidation is going to continue in our industry. It has slowed over the past 18 to 24 months due to the change in macroeconomic conditions. But I think over the next 12 to 24 months, as those macroeconomic conditions kind of return to normal, you're going to see plenty of buying activity and strong EBITDA multiples on the DSO side of our industry. All right, so let's talk about what DSOs are looking for. They're looking for general dentistry practices as well as all dental specialties. So there are plenty of general dentistry DSOs, and there are a lot of specialty specific DSOs. So whether you're ortho, OMS, pedo, endo, perio, there are DSOs that specifically understand your specialty and are buying your practices. And there's a lot of multi-specialty DSOs out there. One of the big models right now is OMS, pedo, ortho, kind of controlling the life cycle of the patient. And then we've got general dentistry DSOs buying specialty practices where they have substantial density, right? So if I own 10 or 20 offices in a particular urban or suburban geography, I've got a built-in referral base. It makes sense for me to start buying or starting specialty offices in that geography. Most DSOs looking for practices located within 60 miles of a major metro area. So urban, suburban practices are going to have more demand than practices in tertiary markets or rural markets. Now, that doesn't mean that if you're located in a rural market or a tertiary market that you won't be able to sell your practice to a DSO. It just means that all things created equal, that practice in an urban suburban market might see 10 offers. In a rural or tertiary market could see 3 or 4 offers. Valuations will be a little softer, likely the multiple will be slightly lower in the smaller market. However, overhead's typically lower, so they're bidding a slightly softer multiple on a higher EBITDA figure comparative to your peer in that urban suburban market. So we already talked about the fact that most DSOs baseline to get them excited $300,000 in EBITDA. If you're running at a 20% EBITDA margin, you really got to hit revenue around 1.5 million to generate 300,000 plus in EBITDA. Minimum 5 operatories. We have sold 4 operatory practices to DSOs, but most DSOs aspire to have at least 2 providers at every location. So if you're a single provider office, that's fine, but most DSOs are going to aspire to bifurcate key man risk by spreading production among multiple providers. Therefore, you typically need 5+ operatories to make that happen and accommodate 2 or more doctors. And then selling doctors and or associates available to continue working 3 to 5 years post-sale. Again, that comes with a lot of autonomy. You can work as much or as little as you want chairside, but you've got to have a vested interest in the business long term. If you're just looking to sell, cut bait, sail off into the sunset, you're going to garner more like a private buyer valuation than you would a DSO valuation if you're looking to leave in short order. So why affiliate with a DSO? Number one reason why a lot of large practice owners are considering selling to a DSO versus selling in a more traditional sense to a private buyer is an elevated valuation. So, what does that mean? So, for instance, let's take a practice with annual revenue of 2 million, EBITDA of 500,000. So that's a 25% EBITDA margin. So in the private buyer world, right, selling in a more traditional sense to a private buyer, one, it's going to be difficult to find a buyer that has the confidence and the competence to buy a practice operating at that level and that can qualify for financing to purchase a practice of that size. But if you can, and it's possible, you might be looking at selling a practice like that for 1.6, 1.7 million. Whereas from a DSO perspective, it's a product of a multiple of EBITDA. EBITDA of 500,000, practice with that level of EBITDA would typically trade for, let's just say, 7.5 times EBITDA. So that's about a valuation of 3.7, 3.8 million in the DSO world, comparative to a valuation of 1.6 to 1.8 million in the private buyer world. So a practice with $2 million top line revenue, $500,000 in EBITDA, trading for twice in the DSO world what it would in the private buyer world. As the practices get larger, that delta between the DSO valuation and the private buyer valuation increases exponentially. For instance, we have a practice right now on the market in Florida. It's under a letter of intent at a valuation of $13 million. So that practice has top line revenue of 5 million. It is valued in the DSO world at 13 million. If you could find a private buyer to buy that practice, you'd be doing good to sell it for 4 million. So again, that practice selling for 3 times what it's worth in the private buyer world. When we start talking about specialty practices, the delta is even larger. Specialty practices are very, very difficult to sell to private buyers. Keto and ortho side, I'm talking about perio, OMS, and endo, but they are highly valued in the DSO world. So obviously, big reason why people are looking with larger practices are looking to sell to a DSO and private equity is a higher valuation comparative to selling to a private buyer. De-risking, for a lot of our clients, their practice is their most valuable asset. They've got a lot of their net worth tied up in their business. They're not diversified. When you look at how their net worth is allocated among the assets that they own, they might have 70, 80% of their net worth tied up in their practice. That is dangerous because for a lot of you, especially if you're a super producer, you're a ski accident away from your practice value declining substantially. So a lot of our clients are looking to take some chips off the table to diversify their wealth among multiple asset classes and not have it all tied up in their business. Another huge reason is alleviating the management burden. So a lot of our clients have built large, successful businesses, but it's come at a cost, right? It's come at the cost of spending time away from their family, not being able to see their kids grow up. They have to deal with the HR nightmare that all of you have been dealing with on a daily basis. But you not only do you have to be a clinician, you also have to be a business owner, right? You got to deal with payables. You got to deal with accounting, especially this time of year. If you're like me, your tax return is on extension and your CPA is pinging you for all kinds of information right now. It's a huge pain in the ass to deal with those types of things on a daily basis and produce dentistry. When you're not working in the business, you're often working on it and you don't really have a break. And then if you take a vacation, that vacation costs you 2 or 3 times what you actually spend because when you're away from the office, you're losing money if you're not producing. So for a lot of our clients, they want to improve their work-life balance. They want to get some help from a management perspective. But I think oftentimes selling to a DSO is associated with taking a step back from your business, that you want to cut back, that you want to offload these responsibilities. Affiliating with a DSO, partnering with private equity, can also be a way to lean into your business and to facilitate growth, to continue to scale the business, to take advantages of the economies of scale DSOs bring to bear, to take advantages of their infrastructure. So a lot of our clients, young docs, 40, 42, 45 years old. Maybe they have one or two locations and they want to continue to scale the business. They want to grow their enterprise. Maybe they want to go from 2 to 5 locations, but they don't necessarily want to do it on their own. They don't want to spend the time. They don't want to spend the money. They don't want to take the risk and see the EBITDA erosion associated with centralizing infrastructure and building infrastructure. And they want to partner with a DSO that's already been there, done it. They can utilize their capital, their infrastructure, to continue to scale the business. So affiliating with DSOs is not just a conduit to taking a step back. It can be, absolutely. But it can also be somebody young that wants to continue to scale their business, that wants to affiliate with the DSO to do so. It offers you the ability to continue working your office long-term following closing. One of the things that's not on here that I think is important to mention, if you partner with the right DSO, you will likely see far less change in your business post-sale than you would if you sell to a private buyer. DSOs of today, this DSO version 2.0, they partner with great practices and try not to screw them up. They support you from a business perspective behind the veil. They allow for a lot of clinical, pretty much pure clinical, and a lot of operational autonomy. They are not physically present in your office on a daily basis versus a private buyer. They're physically going to be there every day, and they may have different ideas about who they want to employ. They might not get along with you. They might not get along with your staff. They're likely going to have a different idea about what they want to do with your practice and where they want to take it than you do. So I'm not advocating for selling to a DSO over a private buyer. I just think a lot of our clients are really, really concerned that if they sell to a DSO, the DSO is going to completely re-engineer their business, and they're going to see a remarkable amount of change. The DSOs that we work with, at least, very little changes in the business post-sale unless you want it to. And again, we do a lot of doctor-to-doctor transitions. I will say that we see far more change in the practice post-sale from a private buyer perspective than we do a DSO perspective. And the other big reason is wealth creation. Participating alongside private equity in the financial arbitrage that they're realizing. Every deal is going to have an equity component, whether it's joint venture equity, equity at the practice level, parent company equity, equity at the DSO level, or a combination of the two. You're going to be allowed to sell all or part of that equity at a recap, hopefully at an exponentially higher multiple than your practice was originally valued at. So private equity's gotten wise to aligning incentives and allowing their doctor partners to participate in the financial arbitrage that they're realizing through utilizing that buy, build, and sell process. All right, let's talk about practice valuation metrics. Already talked about this a couple of times. Healthy EBITDA margin, 20 to 25%. I want to go ahead and make the point here. So everybody talks about, Brannon, what are the EBITDA multiples? What multiple can you get me? The EBITDA matters more than the multiple. Yes, the multiple's important. Yes, it has an impact on valuation, but EBITDA has a bigger impact on valuation than the multiple. Every dollar of EBITDA, look at this chart, every dollar of EBITDA is worth $6.5 to $11 in value. And the number one way that DSOs are opportunistic, and I would say even predatory in some cases, is to convince you that your EBITDA is lower than it is. So know your EBITDA. Whether you're looking to sell tomorrow or looking to sell 5 years from now, you need to understand what your EBITDA is and control that narrative when we go to market. One of the biggest ways we're able to manipulate valuation and get a premium for the practices we represent is to control the narrative regarding EBITDA. We want to make sure that we go to market with the EBITDA level as high as it can be, but also defensible, right? And if we're able to move the EBITDA by 10 to 20% comparative to the non-solicited offer where the DSO is trying to take advantage of you, in combination with moving the multiple by a turn, again, increasing the EBITDA by 10 to 20%, and then increasing the multiple by a turn through creating a highly competitive environment, that is a massive premium compared to the non-solicited offer. On average, our clients, through controlling the narrative regarding EBITDA and then negotiating the multiple, are going to see a 20 to 25% premium on their practice sale comparative to a non-solicited offer. And we'll go through a couple of case studies in a minute. So we talked about EBITDA margin. Let's talk about what impacts the EBITDA multiple. EBITDA level for starters. You can see this chart. There's kind of a pecking order. EBITDA under $1 million, you're probably going to top out around 7.5 to 8 times EBITDA. EBITDA in that $1 million to $2 million range, somewhere in 7.5 to the 9x multiple. And then EBITDA over 2 million, especially if you're a multi-site practice that is a potential platform for a private equity firm to acquire and establish a new DSO, you could trade for as high as 10 to 11 times EBITDA. So the EBITDA level itself is the number one driver of the multiple. And then it comes down to number of doctors, right? What's the key man risk in your business? Are you a super producer? Are you producing, your practice does $4 million a year in revenue. You're the only provider and you're doing $3 million a year of that production. Or are you a $4 million top line rev practice? Hygiene's doing $1 million. And then you've got 3 doctors, each producing $1 million. The practice where you've bifurcated the key man risk through spreading the production among multiple providers is going to sell for a higher multiple than the super producer single doctor practice. Number of locations. So all things equal, right? Same level of revenue, same level of EBITDA, more locations, you might trade for a half of turn of EBITDA higher, maybe even a full turn. But anybody that has scaled a business and gone multi-location understands that more locations equals more overhead. In particular, more staff costs, more occupancy costs. And those are 2 of your, primary overhead expenses when you own a practice. So more locations typically results in lower EBITDA, all other things equal. I would much rather sell a business with 1 location, $5 million in top line revenue, and $1.5 million in EBITDA than a business with 3 locations, $5 million in top line revenue, and $1 million in EBITDA. The single site office is going to sell for more than the multi-site office in that example because the EBITDA on that single site office is considerably higher. More locations does not necessarily equal more EBITDA. I cannot tell you how many calls we are getting on a daily basis. And if this is you, please don't take offense, from practice owners that call and say, "Hey, Brannon, I've got 7 locations." All right. I get excited when I hear that. I've got 9 million in revenue. And I'm like, a high probability that your EBITDA margin is hovering around 10 to 13%. If you've got average revenue of, 1.2 million across all of your offices versus if you had 3 locations and 9 million in top line revenue, your EBITDA margin is probably 25% and your business is going to be worth infinitely more than the other example. So more locations does not equal a higher valuation. It might equal a slightly higher multiple, but it's likely going to lead to a lower EBITDA level. Geography matters to some extent. Again, we talked about earlier, urban, suburban versus rural practices going to have more demand and higher multiples in the urban and suburban geography. As far as where you're at in the country, it doesn't move the needle substantially anymore. It did up until about 24 months ago. So we've got a massive amount of DSO activity in DSO friendly states, as well as states that are seeing massive population growth, especially during and post COVID. So Arizona, Texas, Florida, the Southeast has always been a hotbed for DSO activity. But now we're seeing quite a bit of activity in New England, as well as on the West Coast. And the West Coast has been a relatively new phenomenon. Look, the reality is 20% of the DSOs, 20% of the dentists in the country are in California and the surrounding states. So that market could not be ignored forever. We're starting to see quite a bit of activity on the West Coast. And that's why we established a San Diego office about 24 months ago. Infrastructure matters to some degree, but I'll kind of liken it to locations. Having centralized infrastructure, you would typically only do that if you have 3+ locations. It comes at a cost typically, right? It's a big investment to have and build infrastructure. It erodes EBITDA. Therefore, you need to be doing a higher revenue number in order to offset the investment in infrastructure. So, like having more locations, you might trade for an extra turn of EBITDA if you have centralized infrastructure, but it might negatively impact EBITDA. So, if you are in that lane where you've got, let's say, 3 locations, and you're thinking about going to 5, 7, 10 locations, you're at an inflection point where you need to evaluate, is the juice worth the squeeze? Does it make sense for me to invest in centralizing infrastructure? Because that's going to take time and it's going to take money. And you've got to grow your revenue significantly to offset that investment and just get your EBITDA back to even as to where it is today without that infrastructure. Payer mix, there's definitely a pecking order. Fee for service, PPO, most DSOs love that. When you start talking about capitation or Medicaid, that will impact demand and valuation to some degree. The caveat there is if you are a pedo office, pedo DSOs understand that you're likely going to have some Medicaid in your practice. Once Medicaid crosses about 30, 35%, that's where it starts to impact demand. That's where it starts to impact the multiple. Service mix. Are you a bread and butter practice where there's a lot of upside opportunity through adding specialty procedures? Or, are you a super dentist and you're doing a lot of all on four, a lot of cosmetic cases, average ticket per patient is 10, 15, $20,000. There's more risk in a practice like that, especially when you talk about economic downturns and key man risk. Upside potential. Anytime you're taking your practice to market in the DSO world, not only is it important to control the narrative regarding EBITDA, but it's super important to always go to market with a growth narrative, explaining where are the opportunities for growth in your practice, in your facility, adding additional doctors, adding additional services, ramping up marketing, adding an additional location, whatever it may be. We want to make sure that we're going to market with a growth narrative because DSOs love growth. They will overpay. They will pay a higher multiple on a practice where they know they can buy down that multiple through growing top line revenue and EBITDA. What are your post-closing plans? That's a big one. We talked about the fact that most DSOs are looking for minimum 3 years, ideally 5 years post-closing commitment. Don't wait until the last minute to give us a call and talk about selling your practice. Let's start planning well in advance of your exit from the business. So if you're 7 years out from looking to retire or relocate, now's the time to start the conversation. We might not go to market for a year or two, but let's go ahead and start talking about EBITDA. Let's talk about valuation. Let's talk about post-closing plans. Let's talk about macroeconomic environment. And if you're not ready, let's talk about how do we reverse engineer the goal that you're trying to get to. The last one I'll touch on is your personality. So this surprises a lot of our clients. A lot of people are like, yeah, private equity, they're all about the money. All they care about is EBITDA. They are looking at their doctors as partners. The more they fall in love with you, the more they're willing to pay for your practice. So we always tell our clients, good cop, bad cop. Let us be the bad cop, right? Let us be responsible for posturing, for creating that comparative environment, that competitive environment, for holding their feet to the fire and making sure that they pay the highest valuation possible. You let us worry about that so that you can focus on getting to know the people and being the most charismatic version of yourself. If DSOs like you, they will pay more for your practice. And that surprises a lot of people. So let's talk about deal structures. These are the primary deal structures that you see out there. I'm going to kind of fly through this. Happy to have a one-on-one discussion about this, following the webinar. Traditional DSO deal structure, not many of our clients go this direction, but this is where DSO is going to say set the value of your practice at $2 million. They're going to give you $1.3 million cash at closing. The remaining $700,000 is going to be put on some type of earnout contingent upon you fulfilling your post-closing employment obligation, as well as the practice maintaining revenue and or EBITDA post-close. So in a traditional deal structure, your ceiling is finite, right? You set the value of the business at close, and then your goal at the end of the day is to get that full value in cash over a predetermined period of time. Most of our clients don't go this direction because the ceiling is finite. There is no equity component, there is no arbitrage opportunity, and the holdbacks, the earnouts can be considerable. The next three deal structures are the most common that we see our clients gravitate towards. So the holding company deal structure is where you're going to take somewhere between, let's say, 60 to 70% cash at close, and then the remaining value of your business is going to be rolled into stock in the DSO's parent company. So rather than owning equity at the practice level, you own stock in the parent company of the DSO, and you're diversified across all the practices under that DSO's umbrella. So look, if they're holding a lot of quality assets, it's great to be diversified. But if you're the best asset in the bunch, probably not great to be diversified. The couple of key things to mention about a holding company deal structure, oftentimes you are able to liquidate your equity in full at recap. So you're able to sell all of your holding company equity at recap. That's less common today than it was a few years ago, but still a higher probability than a joint venture deal structure. You need to pay attention to where you're entering the recap cycle. So where you enter the recap cycle in a holding company structure will determine what you pay for that stock. If you're entering early, let's say in year one of a 5-year recap cycle. So let's say that DSO, they recapped a year ago. Now they're in a 5-year recap cycle. You're partnering with that DSO in year one. So you've likely got, 4 to 5 years of holding time before you're able to liquidate that stock. You're going to see a higher return on that equity comparative to your peer who sells to that same DSO in year 4 of that 5-year recap cycle. They're going to see a muted return if they buy that stock later in the recap cycle and have a much shorter holding period compared to someone that's partnering with that DSO early in the recap cycle. So where you enter the recap cycle, at what point in that recap cycle you partner with that DSO in a holding company model is going to determine what your hold time to a recap is going to look like and what your potential upside is on that equity. In a joint venture model, you're going to take anywhere from 50 to 70% cash at close, and the remaining value of your business is actually going to be retained equity, JV equity at the practice level. So it's a true partnership model. DSO is going to own 60 to 70% of the business on the go forward. You're going to retain 30 to 40% equity in that business, and you're going to receive ongoing pro rata EBITDA distributions with that joint venture equity. So if you own 40% joint venture equity in your practice on a go forward basis, you're going to get 40% of the EBITDA after overhead is paid, including a management fee the DSO is going to charge to provide that infrastructural help and those economies of scale they bring to bear. So in a joint venture model, two really, really good benefits. One, you've got ongoing EBITDA distributions, right? You're a true owner at the practice level. It's a real partnership. So you're going to get your piece of the ongoing EBITDA. As opposed to the holding company model, you've sold all the EBITDA to the DSO and all of your equity is at the DSO level. There are no ongoing EBITDA distributions. So that's a big benefit of the joint venture model. The other big benefit of the joint venture model is it doesn't matter when you partner with the DSO as to where they're at in the iteration of their recap cycle. You could partner with that DSO in year 4 of a 5-year recap cycle and liquidate typically part of your joint venture equity at recap at the DSO's EBITDA multiple. So you sell your business in year 4 of a 5-year recap cycle at 7 times EBITDA, and then your DSO partner hits a recap at 14 times EBITDA a year later. You've essentially doubled the value of your retained equity in your business overnight. And you're going to see the full lift on the appreciation in that equity at recap. So that's a huge benefit of the joint venture model is if you enter late cycle, you get the full lift versus in a holding company model, if you're in a late cycle, your return on equity is going to be muted. However, in the joint venture deal structure, you just need to understand that the DNA of that DSO is to have doctors own equity at the practice level. Therefore, you're likely not going to be able to exit your equity in full at recap. There's always going to be some baseline joint venture equity component, call it 10 to 20% of the practice, that has to be doctor owned. So when you're ready to divest yourself of your remaining equity, that remaining 10 to 20% equity, you're going to likely have to sell it to another doctor at more of kind of a traditional practice sale doctor to doctor valuation. The hybrid model is really just a combination of the holding company model and the joint venture model. In this scenario, let's say you take 60% cash at close, the remaining 40% of the value of your business is going to be bifurcated into 20% stock in the holding company of the DSO and 20% retained joint venture equity at the practice level. And then the roll-up concept. So the first 4 DSO deal structures that I just went over are legitimate DSO deal structures. The roll-up concept, in my opinion, I'm going to get on my soapbox for a minute, is not legitimate. And here's what a roll-up looks like. And there's several influencers, consultants out there pitching this concept. The concept is, doctor, your practice on its own is only worth 7.5 times EBITDA. But we are creating a co-op where we're going to wrap our arms around you and 25 of your friends, and we're going to loosely integrate you and pretend like you're a DSO. Even though you're loosely integrated, you don't combine the cap table, there's really no commonality among the offices other than you've all decided to pay a fee as well as management fees along the way to be part of this co-op. The promise is that as part of a larger entity, Doc, you're only worth 7.5x on your own, but we're all going to sell collectively, simultaneously to the same buyer at 12 or 13 times EBITDA. You're going to double the value of your equity simply by joining our co-op. You're going to pay me $25,000 to join, and you're going to pay me $5,000 a month so that I can help you optimize and integrate your business. But in return, I'm going to get you a 12 to 13x on the exit. The reality is the exit's never going to happen. That unicorn offer is never going to happen. Private equity is smart. The dumb money left our space when interest rates doubled. So anybody that's trying to pitch you on the idea of joining a roll up, paying them an initiation fee, paying them ongoing management fees or consulting fees with the promise that they're going to deliver an exponentially higher multiple than you're worth on your own, don't walk away from that concept, run away from that concept. I cannot tell you how many doctors I have talked to that have paid $50, $100, $200,000 to these consultants that are pitching this roll-up concept with the promise of bringing them some unicorn deal 2-3 years from now and have nothing to show for it, and then call us to sell their practice when they're fed up with it. We still get them a great outcome, but they've thrown all that money in the trash along the way. So the roll-up concept, in my opinion, is death by a million cuts. It's not worth it. Yet these people continue to pitch it and continue to take fees from doctors to be part of it. Just had a question come in. When a DSO deal goes bad after close, why? What usually happens? Why doesn't it work out? That's a fantastic question. So we have closed over 200 DSO transactions over the past 5 years. I only have one client uh, who would say it didn't go well up until this point. And look, the reality is that his practice wasn't performing well and he wasn't really employable to begin with. So I don't think he's surprised, and I'm not surprised that things did not go well with his DSO partner post sale because of how we run our process, because it's focused on empowering and educating doctors to understand their options and make good decisions for their practice. And then the process is designed to only put the best of the best options at the table and to help our clients through the diligence process and deciding on, what DSO is the right fit for them. What's their why? What are their goals? And how does that align with the buyers at the table? And then negotiate the most favorable deal structure and most favorable financial outcome. We don't see a lot of deals go south. We don't see a lot of seller's remorse. I would rather get in front of that early and talk about if a DSO deal makes sense for you, if now's the right time, if this is an economic fit, if your why is in alignment with what is available in the marketplace. But I have heard of deals that go bad. And the reason that they typically go bad is it almost exclusively is when a doctor accepted a non-solicited offer and didn't create a competitive environment for their practice. They did not date around before they got married. And they either sold prematurely, they sold to a DSO when it wasn't really a fit for their why. They left money on the table. They negotiated a deal structure that was not beneficial, or maybe they didn't negotiate at all, or they picked the wrong partner, either from a fit perspective or from a monetary perspective, right? The equity promise didn't come to fruition because that DSO was not set up thoughtfully and to be successful long term. Those are the reasons that people have seller's remorse. They either sold to a DSO when that wasn't the proper path for their why, they sold to the wrong DSO, they sold prematurely. These are all of the things that when we talk about scheduling discovery call, going through evaluation process, going through some economic modeling, really doing some diligence before we ever talk about taking a practice to market, that all gets vetted out. And I would say, I don't know, a third, half of our clients, when we get through the evaluation process, they either decide or we tell them now's not the right time, right? You need to wait a year, you need to wait 2 years based on your runway or based on how your practice is currently engineered financially, or what you want out of this transaction is not a fit for what the market will bear. So I think it's really, really important to do some soul searching. Make sure you have an advisor that's completely objective. Make sure you spend a lot of time talking about the why, talking about not just the financial considerations, but also fit, deal structure, goals outside of the economics, and only go to market if it makes sense and only go to market at the appropriate time. That's how you avoid a failed process or seller's remorse. That is the last thing that we ever want for any of our clients. So we're very protective of our clients and we're very objective in regards to our approach. And look, we're blessed to be busy. So we've built a great reputation. We've built a very successful, sustainable company by leading people down the proper path and leading with education. And look, it's the same way that many of you have built your business, right? You take care of your patients, you don't overdiagnose, you educate, you empower them to make good decisions for their the health, their dental health, and the money takes care of itself. So we've put ourselves in that position, allows us to be completely objective. That's why I'm here tonight. That's why we love what we do. And that's why if you Google us, you're going to see, 125-star reviews. You will never see another advisor out there with that type of reputation doing what we do on a daily basis. So I think it's important to align incentives with partner doctors and associates. Make sure that you make promises thoughtfully. If you're going to talk to them about equity, understand that they remember every single conversation that you've had. I'm going to take a little break real quick. Good night, babe. Say hi. All right. See you tomorrow. Um, Consider maybe a profits interest rather than an equity interest. Happy to talk with you offline if you're considering offering equity to an associate. Oftentimes, we get tasked with doing evaluation on a practice for an associate buy-in, And it's a huge practice, right? $5 million in top line revenue. And we'd be doing a disservice if we didn't educate our clients on value of their business from a private buyer perspective if they sell to an associate or a part of it to an associate versus what it's worth in the DSO world. And oftentimes that practice could be worth 3x in the DSO world what it's worth if sold to an associate. And then that creates a very tough decision as to whether you honor the promise that you made to your associate versus considering selling to a DSO. So just understand that you need to make promises thoughtfully with associates. You need to understand that they remember every word of every conversation you've ever had about potentially selling them all or a piece of your practice. Understand that if you have partners in your business, even if they're minority partners, even if you have a tag along, drag along right, which you should have, by the way, so that you have the legal unilateral right to sell the business without your minority partner's permission. You have to have that in any sort of operating or partnership agreement. But if they're a major producer, if they're important to the business and they're not on board with selling and the buyers get wind of that, there's a high probability that's going to impact demand, valuation, and your deal might fall apart. So even if you have a tag along, drag along right, you need to make sure that your partners are aligned in your vision of what the future exit of your equity is going to look like. Um, you're going to need to be prepared to incentivize high producing associates to stay on, and that might involve some sort of post sale retention bonus, um, some sort of equity component that you're going to give the associate, whether that be at the DSO level or the practice level. Most DSOs now have some sort of on ramp for equity. Again, they want to align incentives with owner doctors and major producers. So this slide is really just designed to say, hey, if you're thinking about selling equity, giving equity to an associate, be very thoughtful and mindful that you may eventually want to monetize the business in the private equity or DSO world. And you've got to ensure that your partner doctors are on the same page. We have a lot of conversations with people whereby they get to the point where it's time to monetize the business and the partners are talking a completely different language. They're on, they're at different ages, different seasons of life, different seasons in their career, and they disagree with how they should monetize the business or when they should monetize the business. So being mindful of how associate doctors and how partners impact your exit is critically important. The top mistakes that dentists make in a DSO affiliation: uh, failing to obtain proper representation. If you do not have a sell side advisor, somebody like us, to educate you and empower you to make the proper decisions, to give you perspective, to only put the best of the best options at the table, to control the narrative regarding EBITDA and create a highly competitive environment, you risk making a massive mistake, selling prematurely, selling to the wrong DSO, leaving millions of dollars on the table, and not fully understanding your deal structure and negotiating the best available deal structure. So, first and foremost, you got to build a great team of advisors. You need a sell side advisor on your team. You need an experienced dental attorney on your team. You need to get your CPA involved. Your financial advisor needs to be involved to some degree to talk about, how to mitigate or defer taxes and what you're going to do with the cash at closing when it hits your bank account. Responding to an unsolicited offer. DSOs have built marketing machines designed to get in the door before I do. They spend a tremendous amount of money on marketing. They have a lot of business development people. Their job is to knock doors, smile, and take you to a steak dinner and try to convince you to sell your business to them without proper representation, without dating around, because they're opportunistic. Look, if you or I were in their position, you do the same thing. Their goal is to buy low and sell high. And if they can buy you off market, they're going to buy you for lower than you will sell to if you're properly represented. Look, the reality is it's a cost average game for them. They have built these marketing machines. They're paying doctors to refer their buddies and transact. Um, They're going to buy, let's say, 10 practices in your local market. They're probably going to buy 6 or 7 of them that are unrepresented, off market, and they're going to underpay for them. That allows them to overpay or pay a premium for the practices that we represent because they're just cost averaging them all together. So that's how the industry works from a 10,000 foot perspective. That's why we're able to get a 20 to 25% premium for our clients comparative to that unsolicited offer. Not creating competition. You've got to have multiple bids. That's the only way you're going to ensure that you receive the highest valuation. And it's really the only way you're going to ensure that you have proper perspective as to what's out there. Selling to the wrong DSO, you've got to make sure you define your why, right? What are your goals? Is it purely economic? Is it you want to alleviate the management burden? Is it you want to continue to scale the business? In large part, your goals are going to determine which DSO you end up selling to. We already talked about the importance of controlling the EBITDA narrative. And then you've also got to make sure that you understand the deal terms and the structure. There are a lot of levers in these deals, especially when we start talking about the equity component. If it's joint venture equity, are you going to get your pro rata EBITDA distributions? What is the management fee? What's included? What's not included? Is your practice going to be burdened by debt post sale? Are you going to be able to exit that equity in part or in full at recap? Are you going to receive the full parent company multiple, or is there a ceiling on the multiple? There's so many nuances involved in these deals. It's not just about the EBITDA, the multiple, and the valuation. A lot of other things matter immensely. And for some of you, the second bite of the apple, the equity component, could be worth substantially more or the equivalent of the initial cash at close. So, picking the right partner that has a high probability of exiting that equity with substantial return is also critically important. And then falling for a gimmick. When it comes to gimmicks, we're talking about the roll up concept. We're talking about buy side advisors. There's advisors out there that will say, hey, you don't need a sell side advisor. You don't need to hire Brannon and pay him a commission. I'll sell your practice to a DSO for free because the DSO will pay me. You got to think about that for a minute. If the DSO is paying the commission, who does that person represent? They represent the DSO. Why would the DSO pay a commission to somebody that's going to create a bidding war and drive up the valuation? No, they pay buy side advisors commissions to bring them off market deals so they can buy the practice at a valuation equivalent to an unsolicited offer. They're paying that person a premium so they can save money because that practice never sees the light of day. So please don't fall for a gimmick. Make sure you build a good team. Make sure you have multiple bids, create a competitive environment, and control the narrative regarding EBITDA. All right, so that brings us to our process. So our process always starts with a casual, confidential discovery call. That's a conversation between you and me just to get to know each other. I want to know a little bit about your practice. So talk to me about where you're at in your career, what's your runway to retirement or exiting your business, what's your revenue, number of docs, patient mix, number of operatories, just basic stuff. Does it make sense based on that conversation that we do a full blown EBITDA analysis and valuation? Our only upfront fee is to do the valuation. It's typically $2,500. Now, if you have 3, 5 locations, it might be a little bit more than that. And that's credited towards our commission if and when we close on a sale. And the commission will vary depending on the size of the deal, somewhere in the range of 6 to 8% of the enterprise value of the practice is typically what our commission is at close. Again, we're going to generate a 20 to 25% premium on the valuation side of the equation, plus ensure you sell to the right DSO and you take your practice to market at the right time. All those things being equally important in combination with negotiating the most favorable deal structure. But we get through the discovery call, get to know each other. It's all confidential. It's very casual. Do the EBITDA analysis, do the valuation. From there, we'll schedule typically a Zoom call. We'll go over the valuation together. We can do some economic modeling to show you if you took your practice to market under certain assumptions, certain deal structures, What would the economics look like? Cash at close, annually, and cumulatively over a 5-year window. So we often do a lot of economic modeling before we take the practice to market. So you're very educated about what the global economic implications are of pursuing a DSO affiliation and can make an educated decision from an economic perspective. So if we get through that process and we decide that it makes sense to go the DSO route and take your practice to market, we're going to create a highly competitive environment among multiple DSOs utilizing what we call a blind bid process. Valuation conversation is a private conversation between you and us. When we take the practice to market, we utilize a blind bid process. So essentially, our goal is to create a bidding war among as many DSOs as possible. We're going to help you interview and vet potential buyers. We're going to give you a list of questions to ask each potential buyer. We're going to walk you through those Zoom calls and in-person meetings. Typically, we're going to put the DSOs on a clock. So we take the practice to market, let all the DSOs know, hey, you've got 30 days to meet Dr. Walker, to get to know him, to ask questions about the practice, to do initial diligence. He's going to want to get to know you. He's going to have some questions for you. And then all offers are due. All the offers come in. We're going to typically model out all those offers economically. Again, same way we did pre-market to show you what's cash at close, what does it look like annually, what does it look like cumulatively over a 5-year window. And we're going to talk about not only economics, but also fit, right? Economics aside, who do you like the best? What deal structure are you gravitating towards? And that will help us determine how we're ultimately going to negotiate. Do we have a clear front runner and we're going to we're going to negotiate with that particular buyer, or do we have multiple front runners, multiple DSOs that you feel good about, and we're going to ask for best and final from all of those buyers? So it's our job to negotiate all the major deal points within the letter of intent. And then at that point, once we sign a letter of intent, we're going to enter the closing process. The closing process has 3 primary components. So one is quality of earnings, diligence, essentially. We're going to be there to defend the EBITDA and make sure that the deal terms stay intact throughout the process and there's no retrades. That's a huge part of our responsibility. Then legal. We're going to refer you to a very experienced dental attorney or a number of attorneys for you to choose from. They're going to help explain, negotiate, and navigate the legal agreements. And we'll be there along the way to negotiate any major and minor deal points that come up in the navigation of legal agreements, and then closing. That's going to involve telling your staff, telling your associates, and integration, essentially preparing the practice to operate under a new entity post sale. We quarterback the process from start to finish. And again, our goal is to generate a 20 to 25% increase in your valuation, negotiate a better deal structure than you would get on your own, and give you as much optionality and perspective as possible. So just a couple of case studies before we wrap up for the evening. This is a practice in Florida. Young doc, 40 years old, young family. He was selling to de-risk. He had a lot of his net worth tied up in his business, and he wanted some administrative support because his business was growing rapidly. He did not want to continue growing it on his own. Revenue of 4.3 million, EBITDA of 1.2 million. Our valuation came in right around 8 million. We ultimately took the practice to market utilizing that blind bid process and closed at a valuation of 10 million. That's an 8.5 times EBITDA multiple. This deal closed just a few months ago. Plus, he had a substantial growth related earnout. If the practice grew in the year post sale, he was going to have an additional cash payout post sale predicated upon an equation that interacted with that post closing growth. Being young, he liked the joint venture structure. He did a 70% cash at close, 30% joint venture deal. So he still has 30% equity in his business on an ongoing basis. He'll get 30% of the ongoing EBITDA of the business on the go forward. And he agreed to a 5-year post-closing commitment. This next example I love, and I could give examples like this all night, but this really shows how opportunistic DSOs are and how much money you risk leaving on the table if you accept an unsolicited offer and don't have proper representation. So this practice was located in the Atlanta area. Our client was 58 years old. He had about 5 years remaining until retirement. He wanted some administrative support and wanted to sell for exit planning purposes. Um, he already, so revenue of 3.6 million, EBITDA of 1.2 million. Again, really healthy EBITDA margin, 33% EBITDA margin. He already had an offer in hand at 6.8 million from a legitimate DSO. I mean, compared to selling to a private buyer, that looked like a pretty sexy offer. I mean, it's almost 200% of revenue versus if he sold to a private buyer on a good day, he might get 3.2 million. So he almost signed that unsolicited offer because he thought it was a pretty good offer. It was from a legitimate DSO. His attorney convinced him to call us and have us do a valuation before he signed that offer. And we said, hey, 6.8 sounded good. We think we can get you 8.5 million. He had us run a very limited process. He didn't want to bid it out to a bunch of DSOs. We bid it out to 7 DSOs. We received 5 offers. Ultimately, practice closed at a valuation of 9.6 million. That's an 8x EBITDA multiple. He also had a growth related earnout. Now, he had a 75-25 holding company structure, so he took 75% cash at close and had a 25% stock investment in the holding company of the DSO that he was going to have the opportunity to exit in full when they recapped within 24 months following closing. All right, things I want to draw your attention to. Off-market offer, 6.8 million. We did a valuation at 8.5 million. We exceeded that valuation substantially. We got him ultimately to close at a valuation of 9.6 million. So that is a $2.8 million premium, almost a 50% premium compared to the off-market offer. Guess who this practice sold to? The practice sold to the same DSO that gave our client an off-market offer of 6.8 million simply by us walking in the door, creating a competitive environment, controlling the narrative regarding EBITDA. We increased the valuation by 45% comparative to the off-market offer. If that doesn't show you that DSOs are opportunistic, I don't know what will. And in this scenario, he agreed to a 5-year post-closing commitment. However, he expressed that he only wanted to work chairside for 3 years post-sale. The DSO knew that going into it. They're going to help him backfill his chairside production with associates at the appropriate time. So I appreciate you spending the past hour and a half with me. I hope you found it to be informative and insightful. Couple of ways that we can get in contact. I highly encourage you to schedule a discovery call. Let's get to know each other, determine if it makes sense to do a valuation, do a deep dive, do an EBIT analysis, and quantify, what would your practice be worth if you sold to a DSO. And if now's not the appropriate time, let's re-engineer the outcome that you're ultimately looking to achieve. When I end the webinar, you're going to go to a landing page where you can fill out a free consultation form. You're also welcome to text me, call me anytime. Again, thanks for your time. Look forward to talking to you soon. Hope you enjoy the rest of your night. Take care.